All right, Econ 1A students, today I want to talk to you guys a little bit about what we started talking about this week, which is aggregate demand, aggregate supply, and now monetary policy and fiscal policy. So what I'm going to do is run through an example of an economic crisis leading to a recession and how we would use fiscal or monetary policy to correct it. And then we'll take a look at a couple of other examples together in the Zoom meeting. So I'm going to get started with my aggregate demand, aggregate supply model in equilibrium. We want to remember that we're going to be looking at the price level and GDP for total output for our economy. And we want to compare, let's see if I can get this a little bit closer for y'all. There we go. We want to start out in equilibrium with our long run aggregate demand, long run aggregate supply, our downward sloping aggregate demand. Remember, downward sloping aggregate demand comes from the reality that as the price level goes up, consumers are going to demand fewer goods, companies are going to make fewer investments, do less investment spending, and we're going to see net exports fall. And then we have upward sloping short run aggregate supply, and that's because of the three theories that explain why prices adjust more slowly. This idea that a difference between the expected price level and the actual price level is going to lead to some economic adjustment. That's the sticky wage theory, sticky price theory, and misperceptions theory. So we are in equilibrium right here at some price level, and most importantly at our natural rate of output. And what we want to do is first start with some shock to the economy. So we're going to start with a shock to the economy, which is going to be a economic crisis, right? So we're going to see COVID-19 is our economic crisis. It's going to lead to a decrease in consumption spending, a decrease in investment spending, and a decrease in net exports. And that's because we're going to expect households are buying fewer goods and services. Firms are experiencing a lot of uncertainty, and so they're going to be unlikely to want to expand or invest in new things. And other countries are also experiencing it, so they're going to be demanding fewer of our imported goods. All of these are going to have the effect of shifting aggregate demand in, which means we're going to see aggregate demand decline, output decrease, and the price level fall. So that means that now we have a lower level of output than our natural rate of output, and prices decrease. One of the things you want to notice here is if PE was our expected price level and P2 is the current price level, we'll see that Y is below YN. And you want to remember that Y is equal to YN minus some effect from the difference between P and PE. And so if PE is lower than our expected price level, then what we're going to see is output be lower than it normally would be. So because this is a negative number, say it's P minus PE is maybe that's, say, 2 minus 4, then we're going to have some negative value here. That means that Y is going to be, let me do this a different way. Sorry, that's not the way to do that. If P is less than PE, then we're going to expect Y to also be less than YN. Does that kind of make sense? And so what that means is the short-run aggregate supply curve allows for output to fluctuate around that natural rate of output and prices to change. And actually, prices are the driver of that fluctuation in the short run when we have shocks to the economy. Now, so we move from our initial point here down to here, and if we do nothing, we'll see the economy return over time as expectations adjust. As P becomes equal to PE, then Y will return to YN. But that's not what we want to do as economists. We want to use one of our policy tools. So we can use either monetary policy or fiscal policy to try and solve this problem in our economy. If we use fiscal policy, can you see that pen color? No. If we use fiscal policy, that is going to be government either increasing government spending or cutting taxes to increase consumption. And I noticed in the discussion, a lot of people talked about cutting taxes to increase consumption. It's a good idea, right? We cut taxes, consumers have more income, they spend more money, aggregate demand shifts out, and we return back to equilibrium, right? One problem with that is, what if consumers don't spend that pay cut? What if they end up saving it? Well, it could be good, right? That money would then go to the market for loanable funds, increasing the supply of loanable funds, and lowering interest rates, which would lead to an increase in investment spending. So it could still have a good effect. But there are cases where the government cuts taxes and gives money to consumers, and because of high levels of uncertainty, they don't spend it, and so we don't get that adjustment that we want, that we would get from a cut in taxes. The government can increase government spending so they can build bridges, build roads. We saw this a lot in the wake of the Great Depression. One of the things FDR said was, well, let's get people back to work. So they hired out-of-work Americans to build trails at the national parks and build roads and build a lot of the infrastructure that we still utilize today. So that's really effective because the government does it on their own. They engage in some deficit spending, right? They spend more than they're taking in, but that would move us back to aggregate demand because the government is buying a lot of goods and services. Other thing we can do is we can use fiscal or monetary policy. Remember that monetary policy is conducted by the Fed, and it's going to be one of their ways of increasing the money supply. So they have the three tools: open market operations, they have the discount rate, and they have the reserve requirement. And all of those try to change the federal funds rate with the hope of, change the federal funds rate so that we can increase the money supply, which will then lower interest rates, which will increase investment spending. Sound good? So let's say we want to use monetary policy. So I'm the Federal Reserve Chair. I'm going to use monetary policy. I'm going to use open market operations, which means I am going to buy bonds. I'm going to buy bonds from banks, right? That means that's going to increase cash reserves for banks, which means they're going to be able to increase the amount of loans they make, which is going to increase the money supply, which is going to have the effect of lowering the interest rate, right? So how would that work? Well, I'm glad you asked. We'll take a look at this more in the next Zoom, but the main idea here is that the money supply looks like this. The market for money has some quantity of money here. Interest rate is the price of money, and the money supply is set by the Federal Reserve, and money demand is determined by the price level. And so there's some equilibrium interest rate here. If we engage in this monetary policy using open market operations to buy bonds to increase the cash reserves at banks, to increase availability of loans. That's going to shift the money supply out, lowering the equilibrium interest rate. Lower interest rates are going to make it cheaper to borrow money. That's going to raise the level of investment spending, right? Because remember that aggregate demand is C plus I plus G plus NX shifting it. So if we increase the money supply and lower the interest rate, we're going to see aggregate demand shift back to its original place. Sound good? We'd see the same thing if they lowered the reserve requirement. Remember, lowering the reserve requirement has the same effect. So we could just change it right here. Lowering the reserve requirement is going to increase cash reserves for banks, which is going to mean they can make more loans. It's going to put more money in the money supply because of the money multiplier, right? And it's going to lower interest rates, which is going to spur in new investment by firms. Sound good? You can see the same thing with the discount rate. The discount rate is the interest rate that banks use when they borrow money from the Federal Reserve. If the discount rate is lower, they're going to borrow more reserves, they're going to make more loans, it's going to increase the money supply, moving aggregate demand back to where we want to be. Sound good? So we'll talk more about monetary and fiscal policy this coming week. We're going to have an assignment based on it. We're going to do an in-class activity based on it. Let me know what questions you have. I've seen a lot of really interesting things in the discussion, and I can't wait to talk about it with you. Have a great day. Stay healthy, stay sane, wash your hands, and read more econ.